Hey guys, this is Matt and welcome to the channel. Today we had a monster premium and appreciation day for June 6th. I'm going to talk about how I ran my covered calls, my cash secured puts, and all the nitty gritty details that are important when you run these safe and easy options trading. For anybody that is a new viewer to the channel, this account and the channel is strictly dedicated for income generation, and that's through running safe and easy to learn covered calls and cash secured puts. I'm not here to wait 30 years of investing into a tax advantage account for me to wait to pull out my money. I want to be able to make an income stream either daily, weekly, monthly, or yearly. And the best way I have found so far that's relatively safe is running covered calls and cash secured puts. This is not a dividend growth channel where we see our quarterly dividends come in, for a $200,000 account for SCHD, you'd probably see maybe $1,500. I made $1,500 this last week. We're not playing that game. I'm not doing that long-term dividend growth, buy and hold, wait 30 years. This is not that channel. If that's what you're looking for, there's plenty of other YouTube channels. This is strictly for income generation, and we're going to get to financial independence faster than those other guys because I'm willing to put in a little bit more work every single day. But for anyone that is a returning subscriber, you guys know me. The first thing I like to talk about is the account value because that's the no BS. Is this working or not? It's a quick litmus test, right? If the account's going up, it's working. If the account's going down, it is not working. So guys, currently the account is valued at $162,304.79. And so far from the last 39 trading days of running this strategy, we are going up, up, and away. Let's head over to my Excel spreadsheets. I'm going to talk about all the individual trades I did, and then we're going to look at the holistic view from the last 39 days. So let's head over there. All right, guys, June 6th, in total between premium and then realized appreciation for today, we made $913 together. That is a monster day for a single day. If we take away the appreciation, the premium I locked in was about $599, which is wild. Yesterday, June 5th, I was super excited because I had a super high premium day. And then for June 6th, I had an even higher premium day. It blew my mind that I happened to have this opportunity. But let me talk about the conditions that led to that massive premium day. So the day prior, a lot of cash secured puts were assigned in my direction. I already owned 100 shares of QQQ at the time, but then 2 cash secured puts I was running meant that I had to buy 200 shares of QQQ because they met the strike price, and I had to buy them from the investor I got premium from. So going into June 6th, I had 100 shares of SPY. I had 300 shares of QQQ. I run 1 cash secured put. I had a covered call of IWM that I ran back on June 3rd, which I believe is Tuesday. And for NVIDIA, I ran a cash secured put back on Tuesday as well. So let's break down all the details of what happened today. Let's talk about SPY first. But before I talk about SPY, I have to talk about what a covered call is. So to run a covered call, you, the investor, need to own 100 shares of an underlying, 100 shares, 1 options contract. I owned 100 shares of SPY. So therefore, I ran 1 covered call contract on the SPY. And then for June 6th, I chose a strike price of $5.99. And let me explain why I choose a specific strike price of $5.99. So when I bought these 100 shares of SPY, the cost or the dollar cost average was $596.35 a share. So for me, because the covered call, like you own the shares and then the covered call, you sell your options at a specific price, you always have to make sure whenever you choose a strike price when running covered calls, you choose above your dollar cost average. And usually for SPY, they go in dollar increments. So I bought shares of the $596.35. So at a minimum, I'm going to choose a $5.97 or higher. So for today, I chose a $5.99. When the market opened, I'm in Washington State, so I'm on the West Coast. It opens at 6:30 a.m. The market opened at the 598.63. I thought that was a little bit high, and there was a lot of green the last couple of days, so I was going to be pretty aggressive, and I thought there might have been a little bit of a pullback. As you see, when today closed, it was at the 599.05, so only really appreciated like 40 cents, 42 cents. So my thesis wasn't necessarily too wrong. And ideally, because I chose a strike price higher than my dollar cost average, I got these shares assigned away because when the market closed 599.05, which is higher than 599, I had to get the shares assigned away for me. So then the investor that paid me upfront premium, I had to sell my shares to that investor. But the way it broke down is I made $123 selling that covered call. It was pretty much like at the money. So I made $123 of covered call premium. And then from that appreciation of $596.35 all the way up to $599, that was $265 of appreciation. Now let's talk about the QQQ covered calls I ran. So for the QQQ covered calls I ran, I choose all the strike price at the 531. And the reason why I did that is when the market opened for QQQ, it was trading at the 530. And I wanted to offload 200 shares of QQQ at the money as much as possible, capture a little bit of upside. So that was kind of the thought process, because when I had these QQQ shares assigned originally from a cash secured put, I bought in at the 526 price, the 527, and then my just initial random buy of 100 shares of QQQ, I bought at the 529.74. So theoretically, when I was choosing a strike price, I wanted to make sure I can kind of lump everything together. Usually I choose different strike prices, but today I saw numbers I really liked. QQQ opened at 530. I'm like, if all three of these can get assigned plus $135 of premium, that'd be a massive day. So I took that gamble, and I was a little bit more aggressive on a Friday. I'm cool with having these shares assigned as long as they're above my cost basis, and 531 definitely was. Market opened at the 530, but when the market closed, it was down to the 529.92. All of these expired worthless. So then I got to keep 300 shares of QQQ, and then I got to keep all of that upfront premium. Heading over to the QQQ cash secured put. So the way cash secured put works is investors are going to pay you an upfront premium to offload the shares when the market is heading in a downward trajectory. The only thing that you need to bring as an investor is collateral. That collateral could either be cash or it can be margin. And for me, I chose a 527 strike price when the QQQ was open at the 530. So I went $3 below, and I chose a good strike price. It did not get assigned away from me. QQQ closed at the 529.92. So that was a pretty good move. And the last thing for the collateral, for you to run this option where I made that $71, you would need about $52,700 to run a strike price of this 527. Because whenever you need the collateral amount to buy 100 shares, otherwise you won't be able to run the option. And lastly, finally, my IWM covered call is going to get assigned away from me. I did a strike price of the 209 back on Tuesday, June 3rd. And then when the IWM closed today, it was at the 211.90. It was assigned. I made premium on that Tuesday. And then today I just annotated how much appreciation I made. I bought IWM at the 208.51 and was able to sell it at the 209, bagged $49 of appreciation. Life is good. And end of the day, made $913 of realized gain. $599 was premium, and then the other $314 was just appreciation. Yeah, guys, that was a massive day. A lot of things going down. And then I want to highlight my margin usage, but I don't think this spreadsheet's going to do it justice. So I'm going to explain it better whenever we head to Robinhood. And then I'm going to talk about good margin usage versus bad margin usage. And it really depends on your risk profile as well. Yeah, so let's head over to the other side of the spreadsheet. Let's look at the last 39 trading days and see how everything has been playing out. And we can make a determination together. Hey, is this working, guys? Or is it like, Matt, what the hell are you doing? So let's head over there. This is the favorite part of my videos, is when we start talking about the numbers, tracking the data. Is it going up? Is it going down? And this is the easiest way to understand that. So when I started this options trading, these safe covered calls and cash secured puts back on April 11th, my account was valued at $86,312. Just want to throw out that I threw in about $60,000 after I sold a primary residence that I was living in. So I threw that money in here because I didn't want it sitting in a high yield savings account, because I know I can make more money just in my Robinhood. But yeah, all of my data that I come up with percentage is going to be based off this $146,312.66. Let's kind of talk about before that money so that we can get an idea of how successful this was, and then move on from there. So yeah, account was valued at $86,000. And then before I threw in that $60,000 cash injection into this Robinhood account on May 20th, I was averaging about 12.79%. I will say this, during that time period of me getting all that appreciation, That was when the whole tariff thing happened, when the market blasted down. And then I was able to ride up a lot of appreciation when the market was recovering. 60K transfer happened. And then now the percent gain is diluted a little bit from this 12.79 down to that 10.93. So either way, 10.93% in about 39 trading days is still quite impressive if you were to ask me. And I will take that all day long. For June 6th, like we mentioned earlier, we made $913 of harvesting the premiums and realized appreciation. Over the last 39 trading days, I've made about $12,361.61 of realized gain. This number here is realized appreciation and then premium. Basically, I'm going to have to pay taxes on that stuff. So the trade win percentage, I like to track this because it gives me a reminder of like, hey, there are some days you're going to do better than others. And if you have a red day, we need to figure out why we had the red day. So trade win percentage, I'm winning 97.44% of my days winning, 38 winning days, 1 losing day. And like I mentioned earlier, 39 total trading days. The average premium I'm making per day is about $316.96. The average weekly premium I'm making is quite nice. It's $1,545.20. The average monthly premium is $4,120.54. So you guys see here in the yellow, this is where I come up with some estimates based off the performance of the last 39 trading days. For this average yearly premium, what I did is I took this average weekly premium and multiplied it by 52 because there's 52 weeks in a year. And we are at a number that is, every time we come up with this number, it always surprises me how high it is. It's $80,350.60, right? Because we look at this number right now where I'm at this 12,000. Like, yeah, we've only been doing it for 39 trading days, but we've only been doing this for like 8, coming up on 9 weeks. If we do 40 more weeks of making $1,500, this $80,000 is quite reasonable. That's definitely obtainable. That's if market conditions stay exactly the same. This last, month, markets have been going up. So everything's been going good thus far. We'll see what happens if there's like a pullback anytime soon and how that performance is going to play out over time. But man can freaking dream. $80,000 with a $157,000 or $160,000 account. That sounds amazing to me. And I will continue to dream this dream. But if we look at that as a average yearly percentage, that's about 55% return a year. If we look at the SPY over like the span of its history, it usually averages 10 to 12%, right? 55% is quite a lot. Don't get me wrong, some years SPY is up 30%. It's also down 10% some years. It just depends on when we look at it, but holistically, SPY is up like 10, 12% a year. And for us to make 55% a year, that's going to far outperform any dividend, high income ETF, covered call fund that is on the market today. Let's be honest, guys. I might even make a video of it, making a comparison between some of like the major funds like xdte, gpix, jpq. And I'll try to do like an in-depth video of like, hey, but the problem is I don't think I have enough data to do that. Like, what's 39 trading days? It's a drop in the bucket over the span of how long the stock market has been around and those funds have been around. But it will come down the pipe. Maybe when I have like 6 months of data or like a year of data, I'll get more creative and I'll make that kind of video. But I think it's a little too early to make that comparison. And then when I first started this options trading, April 11th, I had a very realistic goal of $29,740. The gain in 2025 thus far has been that $12,361. And we're only $17,000 away. So we are well on our way to meeting our goals for 2025. I wanted to get a good feeling of how to run these options safely, effectively. And then as I'm displaying it to you guys so that you guys can replicate, because for me, like, yeah, I'll make the money, but I want to be able to give the knowledge and the tools to regular, ordinary people so that they can get out of their social economic world. And I think options trading safe like this is that way. All right, let's head over to the weekly tracker. So with the conclusion of today, June 6th, we've had completed 9 weeks of trading. Of those 9 weeks, 8 of them were green weeks, and then 1 was the red week. As we can see, that 1 red week was based off of 1 red day from April 22nd. Just to kind of give a quick overview, I don't want to like continue repeating myself, but I think it's for anyone that's a new viewer, this is very important to understand. The reason why I messed up and had a almost $1,700 loss on April 22nd is because the market went down because of the whole tariff thing and the whole economic uncertainty, which is fine. It happens. Market went down, and then I bought at a specific price that was a lot higher. I was greedy and I wanted a little bit more premium, so I chose a strike price a little bit closer to where the market was trading at the time. But then there was some good news that came out, and the S&P 500 just shot up, right? I tried to roll my options, but I just didn't roll it good enough. So I still, when I rolled, I chose strike prices that were still below my dollar cost average. And in hindsight, if I would have chose my dollar cost average, I wouldn't have realized that $1,700 loss. But I was greedy and I still wanted more premium because I had to pay so much money to buy my contracts back. And then I didn't choose strike prices high enough. The market blew past it again. Therefore, then, because I run dailies, about 30 minutes before market close, you can't like redo a daily. And then I just lost the money. And then hindsight, did a bunch of research. I literally could have just chose a different expiration date, basically pushed out the expiration date. I would have been able to make more premium. I could have choose my dollar cost average point. So therefore, and then I just wouldn't make premium for a day. So I'd rather not make premium for a day than realize a loss. So hindsight, that will never happen again. And yeah, but just word of the wise, if you find yourself in that situation, just roll the expiration date further out and make sure you just choose a strike price at your dollar cost average. Just wait for the market to recover. Learn from my mistake and my pain. But yeah, and if we look at the last 4 weeks, guys, we are hitting the 4-digit weeks consistently. We had one May 12th. We had that $4,000 week. May 19th week was 1,200. May 26th week, another 1,200. And this first week of June, freaking wow, almost at $2,000. Most of it was actual premium, like a little bit, maybe, yeah, like I don't even know, but a lot of it was premium income. It wasn't appreciation. So therefore, that was quite impressive for me to see. For the monthly tracker in April, we made about $2,289.53. That month was kind of a short month for trading for me. I realized that $1,700 mistake. If I didn't have that, that would have been closer to about 4,000, but it didn't happen. I realized the loss. So I only made 2,200. We live and we learn. I learned from that mistake. And then from that April 22nd, I have not had a red day since. We see a bunch of green. A bunch of green is very good. And then for May, we had a monster month in May. We made $8,073. And for the first week in June, we were at that, almost $2,000. I was $1 away from 2,000. It's kind of sad I couldn't hit it. Whatever. We'll make it next week. And for the yearly tracker, we already talked about it. We are at that $12,361.63. All right, guys. That is a summary. Loving this daily options trading. I love seeing consistent income. I love seeing this account grow over time. And I would love to see your guys' accounts also do the same thing. So let's get out there, let's get after it, and let's start harvesting that premium. And then let's head over to Robinhood. I'll start talking about my account, where it's at, margin usage, some considerations, and then we'll talk about the covered calls and cash secured puts I plan on doing for Monday. Obviously, Monday is a few days away, and then things are going to change, but we'll see. I think it's still good to talk about that strategy. All right, guys, now that we're back at Robinhood, I think the buying power section is going to explain my scenario or circumstance a little bit better. So currently, I do not have any cash because of some of my assignments from QQQ. I am currently on about $6,171 of margin. Some people are definitely afraid of using margin. I am not that guy. I think it can definitely help your account grow a little bit faster, but if you do it responsibly. And so let me explain this. So for me to own about $6,171 of margin over a month period, that's going to cost me about $29. But for me to then have 300 shares of QQQ, 300 shares of QQQ, I can make way more money than $29. Right. And if I really wanted to, because this margin is only about $6,000, if I sell my SPY shares are valued at $9,000, and I could easily wipe this out. But I definitely want that long-term growth. And this $6,000, like if one of my QQQ contracts gets assigned, then it's going to free up that money. And on Monday, I'm definitely going to try to sell one of my QQQ contracts like at the money, very aggressive, and then the other 200 shares of QQQ, I'm probably going to choose strike prices a little further away so I can capture some appreciation, but then also lock in some premium. That's kind of the thought process. And because I have like my event contracts at $120,000, I might also run 2 cash secured puts on QQQ again. So theoretically, I'd run 3 covered calls on QQQ, 2 cash secured puts, and yeah, I don't have enough buying power. Well, I don't want to like use margin to buy another 100 shares of SPY. I want to deleverage my margin usage, and then ideally, I would like this to be 0 at the end of Monday, but if I happen to hold $6,000 of margin, it's $29. It's less than $30 of margin over a month period. So for me, that's like an insignificant cost for me to make hundreds and then thousands of dollars. So that's just kind of my 2 cents there. So let's go to QQQ because that's really the only thing I hold. And I just want to do another call out. There's a lot of people that have like hundreds of shares of like a bunch of different stocks. Look how simple this account is, guys. Look how easy it is to manage. You have 2 ETFs. One is SPY and one's QQQ. Like, I'm blessed that I happen to have this type of an account that's $160,000, and with margin, I can kind of stretch that a little bit. But you can do the same thing with like Amazon shares, Nvidia shares, Tesla shares. Because like to own 100 shares of Nvidia, it's like $14,000. Yeah, you know, might not be making hundreds of, I mean, you'll make hundreds of dollars a month, but like, yeah, you might not make thousands, but guess what? You're still capturing a ton of appreciation if you're doing the strategy right, and you're also making extra premium. That's a double win for me, and I highly recommend doing that. Also, I think like HOD Hood is a good stock too. Let me take a look at that. I think I recommended that to somebody. Yeah, so for Hood, like if you have $7,000, you'd be able to run these options as well. Cool. But let's go to QQQ. Let's talk about the cash secured puts, covered calls, and that whole shebang. So guys, now that we're at QQQ, let's head over to the trade QQQ options. For all the returning subscribers, I'm sorry. This buy call button, don't do it. There's going to be temptations to do poor man's covered calls or credit spreads where you have to like buy options. Just don't do it. It's you as an investor are going to have to pay that upfront premium to somebody to run that option. I think it's better for you just to own shares, capture some of that appreciation, and then gain premium off of choosing strike prices further away from the money and then your dollar cost average. That seems like a better recipe than success than hoping that when you buy call that the option is going to go your way. Because the thing about options is every day the option doesn't go your way, you're losing money to time decay. So you're losing money every day versus covered calls. You are making money every day if you can run them daily, or if you run them weekly, you're making money weekly. Just food for thought. So to run a covered call in Robinhood, just do sell, call. Easy enough. And right now the expiring is June 9th. By the time Monday rolls around, it's going to be June 9th, and it's going to be 0D, which means 0 days to expiry. I like to run options daily. Sometimes if you run options as week long, you're going to make more money. Or if you have an individual holding like an Nvidia and Amazon or some sort of stock, you could only run weeklies at a minimum. Some stocks and ETFs, you only run them monthly. Just food for thought when you guys are deciding what funds to invest in or what stocks to invest in. Take that into consideration. I like to run things daily because when the market fluctuates, I'm able to adjust my strategy according to the market. Market shooting up, then okay, I can choose strike prices. So I can maybe capture some of that appreciation. Market going down, all right, I should probably choose cash secured puts a little further away because the market is tending down. You know, it's just things like that. All right, with that being said, I own 300 shares of QQQ, and I'm going to explain my strategy. So that just makes, it'll just be explaining it will be a little bit easier. So QQQ is trading at this 530.75. So theoretically, if I run another 531 strike price on those 3 contracts, I'd make $180 per contract. So I'd even make more money than what I made on Friday, because the covered calls on Friday were only $135. And then if I ran them today, which wouldn't execute, I'd make $180 of premium per contract. But let's see. For 100 shares of my QQQ, I'm probably going to just sell this at the money, lock in this $180. But the other ones, I might just kind of offset them. So I'd have, just so I can capture some of the appreciation. We don't know if the market's going to go up this high. And then if I do that, I'd make $419 if everything stays exactly the same. When the market and the pre-market happen, things change. But as of right now, if I were to run this, I would make $419. But let's take those away and just kind of blanket talk about running a covered call. So the way a covered call works, you need to own the 100 shares of the underlying, 100 shares, 1 options contracts. That's where we're at right now. Now let's talk about the transaction. An investor is going to pay you an upfront premium so that you can sell your shares at this 533 strike price. And there's 2 things that can happen. One, the covered call contract can expire worthless, which means you made that upfront premium of $102. And then at the end of the trading day, the QQQ at 530.75 did not appreciate up to 533. So therefore, you get to keep your shares and you can rinse and repeat this the next day or however your strategy is if you're running weeklies. But that's how that works. Second thing that can happen is the QQQ actually appreciates and it hits your strike price at this 533. Therefore, you are going to get your shares assigned, which means that they're going to be sold to that investor that paid you that upfront premium. So it's a quick, simple transaction. And there's 2 drawbacks to running covered calls. The first drawback is if the QQQ continues blowing past, your strike price at this 533, like say goes to, 543, you theoretically lost the ability, or you lost the opportunity of making $1,000 of appreciation for those 100 shares of QQQ that you own, but it's not guaranteed. It's not realized until it actually happens. So yeah, sure, it can go up $1,000, but they can just as fast go down. So for me, I don't necessarily think that's like that's not like a consideration to really like rule out or rule in. But the other potential side effect of this strategy is say we bought the 100 shares of QQQ at this 530.75. We chose a strike price 533, but then the market decides to go the complete opposite direction at this 523. So theoretically, you lost about $700 of appreciation from this 530. It's not realized until you actually sell the shares. But ideally, the premium is, if you're going to be running covered calls and you're trying to choose premium that is around your dollar cost average point, you're going to be getting really bad premium, as I mean really bad, like maybe a $1 a contract bad, where it's almost not even worth like selling. I would still do it because any money is better than no money. But you might have to deal with bad premium until the market recovers. Or you kind of could do what I did on April 11th, where you choose a strike price, maybe not exactly near this 523. Maybe you choose something at this 527 or 526 with the hopes of locking in a little bit more premium. Yeah, you're risking, we'll say this 527. Yeah, you're risking about $300 of loss if the market shoots up and then you get assigned at this 527. However, if that's about to happen, you can always roll your option, choose the expiration date a couple days away, choose the strike price as your dollar cost average. So theoretically, you wouldn't lose the money. So those are kind of like different choices and trade-offs. So that's the QQQ covered calls. What I plan on doing for Monday, kind of a little spread out strategy, a couple dollars away, but ideally I do want to try to get 100 shares of my QQQ assigned. For puts, sell puts, let's describe how that works. So usually when I look at some of these options, I'll start with like $5 away. So we'll see what this 525 strike price put means. So there's a delta of 21. So 21 means there's a 21% chance of this cash secured put getting assigned. Look at the premium, $74. I like that. I would probably bag that because I usually like to trade options at that 0.2 to 0.3 delta. The premium's the best. And it's like you can usually get, if the QQQ goes down, and you're going to get these shares assigned at a relatively decent value. So let's use this 525 strike price as an example. So the way it works, investors are going to pay you this upfront $74 to lock in selling their shares if the market were were to go down to the 525 strike price. And kind of like the covered calls, there's two different things that happen here. Expires worthless, which means the market does not go down to 525. For that transaction, you do need to bring collateral. You need to bring about $52,500 of collateral to run this 525 strike price. That's just kind of, throwing that out there. So you need to bring that, and expires worthless. Investors paying you that upfront premium, $74. And at the end of the trading day, you get your collateral back to you, and then you can rinse and repeat this the next day, or however you run your strategy, if it's weekly or not. Second scenario, it actually gets assigned. Market goes down from 530 to 525. You then buy these shares at the 525. And then now that you own the shares, you can just run them at a covered call strategy. You can do whatever you want with them. And I don't have to beat the dead horse of like what to do. It's just a covered call, as we just talked about it. But the one side effect of running cash secured puts is if the market continues to tank. We kind of highlight this for the covered calls as well. If the market tanks when you got the shares assigned to 525, you kind of have the two options of like, okay, selling premium at your dollar cost average point, or it's like you risk potentially getting your shares assigned for a loss to make more premium, but then you also have the option to roll it. So it's kind of whatever your risk profile is. Personally, for me, I would wait about a week before I start getting too frosty with choosing strike prices that are closer to at the money if the market is below my cost basis. But I say that, and then what I actually do might be completely different. All right, guys, I want to highlight a comment that Donnie H3497 mentioned, and I hear this quite often, is like when I run my options. Specifically, his question is when I buy the 100 shares for the day. It depends on the day, but ideally, if I don't have any shares of like QQQ or SPY, I will buy 100 shares immediately when the market opens. I don't wait around because I want to then immediately run a covered call on that position so that I can start making the money right away. I do this because the way that options work is you lose money to time decay, and the more time you wait is the less money or less premium you are going to make. And when you've heard traders claim that they do much better if they sell options after 10 a.m., I'm on the West Coast, so 10 a.m. might be different. So I don't know if that's East Coast time, Midwest, West Coast time. But I think they're trying to say this is like the later you wait in the day, the volatility is going to be a lot more level. And I think that's more so if you're trying to buy options and then kind of like ride out a storm. Because the first like 30 minutes to an hour of the market is usually like up and down. And sometimes when I run my options personally, I might wait 15 or 30 minutes before I run the options to see like, hey, if there's like a straight shot shooting up, that might be a time where like, okay, cool, I might run my covered calls immediately because I want to capture that upside. Or if then the reverse happens, the market's going down, be a great time for cash secured puts. So it really depends, but for, I would say 90% of my days, I just run the options. I buy my shares and I run options immediately when the market opens, and I just get it over with. It takes me 5 minutes, and then the rest of the day I just wait, and I don't even have to look at my account. And I just, when the market closes, I check to see, all right, what was assigned, what wasn't, and then I start making my plan for tomorrow. So hopefully that answers your question. I do want to do a shout out to Dave. Dave has been giving me a couple of great comments lately, and I just want to do a shout out to you. Thanks, Dave. Appreciate you, and I appreciate all of your comments to make this channel and community a lot better. So yeah, shout out to you. Yeah, guys, that wraps up the video. Hope you enjoyed it. Hopefully this is something that you can adopt into your trading strategies. Matt out, and I will see you in the next video.